High-income ETFs have become extremely popular over the last few years, and covered call ETFs in particular have become a core holding in many investors' portfolios because these ETFs maximize income generation by selling call options on their underlying holdings to generate premium income, which is then distributed to investors as a dividend yield, typically upwards of 10%. The high income serves as a great source of cash flow while also minimizing portfolio volatility by cushioning the downside with the extra income. And at times of heightened market uncertainty, like right now, these ETFs can be extremely effective. They also allow investors to regularly dollar cost average into stocks or ETFs that go on sale, thanks to their frequency of dividend distributions, which tend to be on a monthly or even a weekly basis. And this can be a game changer when it comes to compounding growth over many years. Now, every time we see a significant market sell-off, that is when you need to pay very close attention to these ETFs, because it's during periods of volatility that their covered call strategies truly reveal their strengths and weaknesses. And I have been closely monitoring several ETFs to see which strategies hold up better under pressure. And remember, the whole purpose of these funds is to minimize portfolio volatility through the use of income. And there's one high-income ETF in particular that has truly amazed me at how well it's been able to not only generate very high levels of income, but also minimize the volatility of its underlying holding, the QQQ, by more than 60%. Outperforming it by 6% since inception. No other high-income ETF has been able to provide such superior returns. In this recent sell-off, this ETF has been able to outperform its peers by an average of 2 to 3%, while beating the QQQ by around 5%, capturing around half of the volatility of the QQQ, and that level of outperformance is just amazing. So today, I'll be going over this ETF that, in my opinion, has the potential to become one of the best performing high-income ETFs down the road, and could be one of the most effective covered call ETFs, and it is all because of its underlying strategy. Now, I say could be because there are a few factors that need to be considered. In this video, I'll be explaining how this ETF works in detail, compared to other popular high-income ETFs, and discuss the reason behind its outperformance, and talk about the importance of one of the most effective stock-picking strategies. And towards the end, I will provide my honest opinion about the fund and whether this ETF could become a core holding for investors. And this brings me to QDVO, which is the Amplify CWP Growth and Income ETF. I have been a very big fan of Amplify ETFs, especially DIVO, which is another one of their funds that has been regularly ranked as my top 4 high-income ETFs. Now, DIVO is a value-focused ETF that uses a covered call strategy, but QDVO is a growth-focused ETF with a unique covered call strategy, and a DIVO and QDVO pair could make a very powerful ETF combo. But I will discuss that in another video. We have to compare QDVO to other growth-oriented covered call ETFs like JEPQ, which has been one of my favorites, QQQI, QDTE, GPIQ, etc. And before we continue, let's quickly run through the fund's fundamentals so that you can get a better understanding of the ETF. Now, before we continue, I wanted to let you guys know that I just released a free dividend ETF cheat sheet that breaks down the 7 key metrics every smart investor should know, plus my #1 way to spot a dividend trap. You can grab your free cheat sheet by clicking the link in the description or comment section below. QDVO was established in August of 2024, so it is extremely new. QDVO's assets under management are growing rapidly, closing in on 500 million. So if you do plan on purchasing shares of the ETF, it may be slightly more difficult as the bid to ask spreads are pretty wide, so there may be higher transaction fees. But once the fund accumulates more assets, liquidity won't be a problem. So just keep that in mind. Moving on, currently the fund has a dividend yield of around 10%, which is on par with other high-income ETFs in its category. Now, since inception, the fund has managed to outperform every other high-income ETF in its category, outperforming its underlying index, the QQQ, by a very significant margin. But what really stands out is that this outperformance has been consistent since inception. And this, in my opinion, is the most intriguing aspect of the fund. So how was it able to capture such a larger upward momentum relative to its peers and the QQQ and provide better downside risk mitigation despite using a covered call strategy just like the others? I mean, I'd understand a slightly better performance, but this is very significant. Well, it all revolves around the fund's unique strategy. You see, funds like JEPQ or QQQI are investing in stocks within the Nasdaq 100 and selling call options on the Nasdaq 100 index to collect premium income. This last part is what I want you to focus on. I'll circle back to it in just a second. Now, if you want access to the same comparison tools, charts, ETF screeners, and ETF deep dives that I use in all of my videos, then I highly suggest to sign up with Seeking Alpha. And right now they are running their Black Friday sale with 20% off site-wide. That includes $60 off their annual premium plan, $100 off their Alpha Picks portfolio, plus savings of over $220 on their premium and Alpha Picks bundle. I highly suggest to take advantage of the sale before it ends. You can use my link in the comments section or description down below, and once again, you get 20% off site-wide on Seeking Alpha. Now, JEPQ does have some slight variations in terms of what stocks it holds. It is not identical to the QQQ, but QQQI's holdings are identical. However, QDVO only holds around 50 to 60 stocks, sometimes only 40 stocks, so it is a lot more concentrated. Now, based on the fund's description, the fund is actively managing a narrow portfolio of large-cap US equities with strong dividend growth. In other words, that means strongest earnings growth outlook, strong growing margins, and strong cash flow growth. This on its own provides an extra step to enhance growth potential, as companies that exhibit the strongest earnings growth will undergo the strongest appreciation over time. Plus, companies that exhibit very powerful cash flow are also subject to less selling pressure relative to others, because these are reputable stocks that growth investors are more likely to put their money into. So this filter, in my opinion, gives the ETF a slight edge over other high-income ETFs. And this goes to show how powerful the dividend growth metric can be. It doesn't just apply to traditional dividend ETFs. Applying that same principle to growth-focused ETFs can be incredibly effective over the long term. Now, it's important to clarify that it doesn't mean this fund will exhibit strong dividend growth. Covered call ETFs generate their yield primarily through option income, which means that distributions can fluctuate based on market conditions. That is exactly why most covered call ETFs tend to lack consistent dividend growth, because the payouts are driven more by the strategy than by rising company earnings. And that is very important to remember. When you look at its top holdings, it is pretty close to the QQQ and JEPQ, and that is why its performance is still similar. But I think this extra concentration can help with its appreciation ability. Now, the truly amazing part about this ETF is its covered call strategy. This is why the fund saw such powerful growth during this period. You see, almost every other high-income ETF out there is selling call options on the Nasdaq 100 index, which means that the outcome of those call options, whether they are successful trades or losing trades, is all dependent on the performance of the entire index. But as we know, covered call strategies limit upside potential. So by selling call options on the entire index, you are limiting the upside potential of every single underlying stock. But what if certain stocks are subject to more growth potential than others? For example, if you look at Microsoft right now, the stock is now selling off. But stocks like Broadcom are on an insane rally in the last year. So capping the growth of Microsoft would make a lot more sense compared to capping the growth of Broadcom. And again, the reason these stocks are growing is because investors are seeing higher earnings growth potential, so QDVO is using a tactical call writing strategy. Instead of selling call options on every single stock within its holdings, the fund managers are choosing specific stocks that, in their opinion, are better suited for it. And this selective approach allows specific stocks within its holdings to appreciate without any cap. Now, they may also sell calls on a strong momentum stock, but choose to sell those really far out of the money to give it as much room as possible to appreciate. So the premium income it collects will strictly be coming from stocks that the fund managers think are best suited for a covered call strategy. That is why when you look at the holding breakdown of the ETF, less than half of the stocks have call options written on them, and the rest are free to appreciate without any cap. That is how the ETF was able to outperform its peers by such a significant amount during this period. Now, I mentioned a winning trade or a losing trade, and what this means is when an investor sells a call option on a stock and collects premium income, the underlying position is essentially bearish. So if the stock trades below this cap that has been placed for a specific time period or expiration date, then the trade is successful, and therefore the investor keeps all of the premium income and can repeat the process. But the trade is unsuccessful if the stock appreciates beyond the cap. So despite the investor collecting the premium income, they have to roll it over and close it for a loss. And that loss is what eats into the total performance of a covered call ETF. So when we say a fund caps upside potential, it really means that covered calls have a tendency to be unsuccessful and the losses eat into the total returns. But now you can understand why a fund like QDVO has the potential of outperforming its peers. And if the fund managers are successful at deploying its strategy on the right stocks, then it has the potential to appreciate much more than typical covered call ETFs like JEPQ. Now, this also comes with a few potential downsides. For one, the fund managers could make a mistake and cap the growth of a stock that could be subject to extreme growth. But frankly, every covered call ETF is subject to the individual decisions of the fund managers. They are the ones who decide how much they will cap the growth of the fund and how it will perform down the road. But the second downside is the concentration. Funds that are more concentrated have a tendency to exhibit more upside and downside volatility. But the margin of underperformance will likely be very little. And remember, these guys are professionals. And in the case of QDVO, given the amazing performance of DIVO, I am pretty confident that they will successfully deploy a very powerful covered call strategy. Now, there are also a few other details that we have to talk about. First, the fund has a relatively high expense ratio of 0.5%, which is in line with its other high-income fund, DIVO. However, this isn't too different and is actually on the lower end of most high-income ETF expense ratios, such as SPYI and QQQI, which both have an expense ratio closer to 0.7%. Now, another very important detail is that all of the dividends distributed from this fund are considered return of capital, which means that dividends from this ETF are very tax efficient, and in my opinion, that makes it extremely favorable for income investors and retirees. And for those that don't know, return of capital is a classification of dividend distributions where they are tax deferred until the adjusted cost basis reaches zero. And afterwards, all dividend distributions will be taxed as long-term capital gains. Now, I did already explain this in detail in another video, but to give you guys a brief summary, the concept of return of capital is essentially returning a portion of your original investment in a fund back to you in the form of a dividend. And since this isn't actual income generation, it isn't taxed when received. This means that the dividends you receive from funds like QDVO, SPYI, or QQQI are tax deferred and you don't pay taxes on them immediately. However, this tax advantage doesn't last forever. As you receive these returns, your original investment or adjusted cost basis gradually decreases. For example, QDVO has a dividend yield of 9%. So had you invested $100,000 in the ETF, in year one, you may receive $9,000 in return of capital dividends. So now your original investment amount, or ACB, which was $100,000, goes down to $91,000. And in the following year, let's say you collect another $9,000 in dividends as return of capital, now your adjusted cost basis goes down to $81,000. And this continues year after year until your adjusted cost basis eventually reaches zero. This is something that you have to keep track of yourself. Very important. So essentially, you've gotten back all of the money that you originally invested. And remember, none of these distributions were taxed. However, after your ACB hits zero, every further dividend distribution will be taxed as capital gains indefinitely. So overall, in my opinion, QDVO has the potential to become one of the strongest performing covered call ETFs in the market. But again, its performance is heavily tied to the fund manager's decisions and the stocks that they choose to sell calls on. But given the performance of other ETFs that use a similar strategy, I am pretty confident in its long-term prospects. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit that thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. Bye! This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.